In our complex economy, making a living is a process of getting and spending money. We get our income in money, and we spend that money for the things we want. The money itself has virtually no intrinsic worth and is merely a measure of value, a medium of exchange for the payment of debts and for purchases of goods and services. Only about 20% of the money in the United States is in currency and coin. The other 80% is checkbook money. And that checkbook money is in the form of deposits in our commercial banking system. Commercial banks are the only private financial institutions in America that provide means of payment by check. Commercial banking in the United States is part of the private enterprise system. And just as auto mechanics offer services for a fee and grocery stores vie for the consumer's dollars, commercial banks must compete with many other financial institutions to attract checking and savings accounts, which provide them with the money they need to make loans. That is why the banks are open and their signs out to sell their services to the public. Most banks have deposits insured up to the sum of $15,000 by the Federal Deposit Insurance Corporation. State and federal governments have enacted regulatory legislation to further protect people who do business with banks. Commercial banks provide their customers with a wide variety of services.
Hello, I'd like to make a payment on our car.
Miss O'Dowd, in reviewing your estate, our trust department feels that a little more liquidity is desirable, and they suggest converting the real estate property on Olympic Boulevard into government bonds. Are you agreeable to this?
Yes, I am agreeable.
Here you are, sir, your Series E bond.
We have all the information we need in order to close the escrow on your new home.
I'd like to run a safety deposit box.
Yes, sir. Do you know what size you'd be interested in?
Well, I have some securities and some jewelry and some other stocks and bonds I'd like to keep in it.
1, 2, 3, 4, 5, 6, 7, 800 francs.
Thank you.
All right, sir. That'll be 5 $20 traveler's checks. 1, 2, 3, 4, 5. You just sign on the top line.
Okay.
Here's your money order for $25. Would you sign right here, please?
Here you are.
Thank you.
I want to deposit $100 in my savings.
The two most sought-after services at banks are time deposits, which are called savings accounts,
I'd like to deposit this in my checking account.
and demand deposits, better known as checking accounts. The single most active department in any commercial bank has to do with checks. A check states how much money is to be paid, to whom, from whom, and through what account in what bank. With enough money in the bank, an individual can write a check in any amount and send it safely by regular mail, thus averting the need to ship large amounts of cash from one concern or individual to another. There is little danger of loss or theft, since payment can be stopped on a check, and a check cannot be cashed or deposited until it has been endorsed by the named payee. A check that has been endorsed and paid serves as an automatic receipt of payment. Canceled checks are returned by the bank to the depositor, usually every month, accompanied by a statement of the account balance. Checks are used to pay 9 out of every $10 we spend, and some 16 billion checkbook dollars move around the United States every day. John Drake, like many young men his age, has already learned the usefulness of a checking account. Enrolled in a West Coast college, John uses checks as a simple way to pay his bills and to keep track of his expenses.
$14.50.
Thank you very much.
He receives some money from home and also holds a part-time job. Today, John and his girlfriend are about to consider a major purchase for the coming summer months.
Boy, they got some great boards.
Johnny, look at that one.
Oh, Johnny, I like this red one.
No, how about yellow, or maybe, look it over here.
Look, this would match the car.
We don't want something to look at, to surf on.
I know, but it should match something we have.
What we're looking for is something that I can ride, you know, for my weight, and yet she can still learn how to surf on.
You weigh about, what, about 150 pounds?
Right.
But it has
Well,
to be
board-
just right for me, too. Because he's going to teach me
Well,
how to
most
surf.
important, it has to be just right for him.
No, most important, it has to be right for my wallet.
His choice made, John writes his check.
There you go, $145.
Do you have any identification?
Driver's license?
That'll be fine.
Shows proper identification, and the board is his. It's that simple. Banking time for Chris Hansen, owner of the surfboard shop.
Hello, how are you today, Mr. Hansen?
Fine, very good.
How's your surfing business?
Picking up, thank you.
That's nice.
As the proprietor of a neighborhood business, Chris is well known at his local bank. Today, he will deposit the weekend's receipts. Some cash, but mostly checks, including John Drake's. Few people realize the effort that goes into the handling of checks in a modern bank. When Chris Hansen's bank gets John Drake's check, it and all other checks received that day are sent to their own check processing center. Here, the amount of John Drake's check is added to Chris Hansen's account, even though Hansen's bank has received no money from Drake's bank. The dollar amounts of all checks drawn on Drake's bank and deposited during the day are added together to make a grand total. At the same time, Drake's bank adds up the dollar amounts of all the checks it received, which were drawn on Hansen's bank. These two groups of checks, together with their dollar totals, then go to a local clearinghouse. The clearinghouse compares the dollar totals of the checks drawn on the two banks and records which of the two banks owes the other money. Each group of checks is given to the bank on which it was drawn. At Drake's bank, the amount of his check is deducted from Drake's account. If there's any disagreement on the amounts owed between banks, computers in check processing centers quickly verify the day's check transactions to correct any errors that might have been made. Banks, together with clearinghouses and the Federal Reserve System, make possible the daily payment of billions of dollars of checkbook money. However, banks seldom earn much of a profit on handling checks. Many make no profit at all. A bank's major income is earned through charging interest for their services of lending money to borrowers. Today, a high percentage of the more expensive items we buy are purchased with borrowed money, with consumer loans.
Yes, sir. May we help you today?
I'm kind of interested in this car.
That's a fine car. It has air conditioner, deluxe interior.
It says $4,100 on the glass there. What can I get it for?
Well, it all depends on what you'd want on it, and what you have to trade, but we can go inside and talk that.
Fine.
All right, Mr. Wilson, I think you'll find that all in order there.
Now, that's white sidewall tires, power steering, air conditioning, and you're allowing me $700 on my car.
That's right, Mr. Wilson. Now, we also offer a fine financing plan through our company if you wish to finance through us.
Well, I'd like to talk this over with my banker. They've been doing all my other financing. I just got my real estate license, and I've been offered a job by one of the top realty firms. Now, one of the requirements is that I have to have a late model car. I like this when I looked at today, so I'd like to see what kind of financing we can work out on it.
Well, now, what do you expect to be earning in the new job?
$400 a month draw plus commissions. Those who have been working for the company for 6 months or longer are getting a minimum of $1,000 a month.
Fine. Now, I noticed by the dealer's purchase order here that you got $700 for your trade-in. How much do you intend to put down in addition to that?
$700 down.
That'll leave a balance of $27,3865 to be financed. Now, while I'm looking up interest charges and ways to approach this, why don't you fill out our loan application, if you will?
Yes, sir.
To establish his credit rating, Tom Wilson states in writing where he works, how long he's been employed, where his new job is, how much he'll earn there, how much money he has in savings and other items of value, how much he owes, and to whom he owes it.
I guess that's just about it, Mr. Caldwell.
Every loan is carefully scrutinized on the basis of the borrower's ability to keep up his payments. In Tom Wilson's case, he's borrowed money from this bank before and has a good reputation for paying his monthly charge accounts on time.
Taking the liberty here while you were filling out the form of looking in the book and making a suggestion for you. I think the best answer for this loan is our straight auto loan.
How much interest will that be?
In dollars, over a 3-year period, 36 months, at 6%, our existing rate is $551.03.
What will the monthly payments be?
The monthly payment over 36 months is $91.38 a month. Now, this includes a nominal charge for life insurance to protect the loan, which I think is to your advantage.
Well, that's just fine. In fact, it's less than I expected to pay.
Good. Well, there's nothing further to do then for us to prepare the draft, which we will have done, I should think, by noon tomorrow. And if you can come back at that time, we will hand you the draft, and we have ourselves a deal, and you have yourself a car.
Tom Wilson gets a new car, and the bank puts dollars out on loan to earn a profit. The auto loan was based on what is known as an add-on interest rate of 6%. Multiplying 6% interest times the amount borrowed times the 3-year loan period gives a total interest charge of $492.96 for the 36-month loan. Dividing the interest charge of $492.96 by 36 months gives a monthly interest payment of $13.69 for 36 months. There is a monthly cost of $1.62 for the loan insurance. This cost, plus the $13.69 interest charge, plus the repayment of $76.07 on the principal, add up to $91.38 to reduce the balance owed by that amount every month. By the 24th month, the balance due would be reduced to $1,096.56. However, the interest charge remains the same as it was the first month, when the amount owed was $3,289.68. Thus, by paying the same interest every month for 36 months on a declining loan balance, the borrower is actually paying approximately 11% simple annual interest on the money he borrowed at 6% add-on interest. Banks also earn profits on commercial loans. This president and treasurer of a medium-sized corporation are seeking a $2 million loan from their local bank.
Mr. Johnson, here's the most recent appraisal of our equipment, machinery, and real estate, worth $4 million. Most of it, as you can see, is free and clear. We intend to use it as collateral for the loan.
I presume you've studied the report on our company over the past 5 years.
Yes, we have, Mr. Andrews.
And the projected sales plan over the next 5, if we get the loan?
Mm-hmm. We were wondering why you have to take on such a big obligation to keep your share of the market.
Well, frankly, we don't have any choice. Production's already at capacity. And if we don't expand, the competition can run us right out of the market.
You're figuring an increase of $500,000 a year in net profit if you get the loan, is that right?
That's right. As you can see, with what we're earning now, we'd be able to meet our obligation if you can give us a 5-year payoff.
What kind of interest were you planning on paying?
With $4 million collateral, 6%.
Well, I'd like to, but I can't. We're almost loaned up, and we've just raised the interest on our savings account. We have to pay more for our money, so we have to charge you more.
Well, what are your best terms?
6.5%. Well, that's the going rate anywhere around here now.
Mm-hmm. Charlie, what do you think?
It's still a very good loan.
Mr. Johnson, you've got a deal.
Good.
Now, here's a resolution passed by the board of directors of our company authorizing Charlie and me to negotiate the loan. I think you'll find everything's in order.
How much time will you need before you can give us a firm commitment?
Our loan committee meets every day. We can let you know right after the next meeting.
Fine.
The corporation's $2 million loan for a 5-year term at 6.5% simple annual interest amounts to a monthly payment of $39,140. This payment includes principal and interest. Multiplying $2 million by 6.5% gives a simple annual interest cost of $130,000. Dividing this by 12 months, the first month's interest payment is $10,833. $28,307 payment on the principal reduces the loan by that amount. By the 31st month, interest on the declining balance is $5,853. $33,287 is paid on the principal. By this monthly reduction in interest charges on a declining balance of money owed, the borrower pays 6.5% simple annual interest. Today's commercial banks list on their records over $200 billion in outstanding consumer and commercial loans to individuals and businesses. In addition, banks also make public loans. They lend more than $100 billion a year to the United States government, to states, school districts, cities, and other public organizations. And most of these $300 billion of loanable funds are obtained from checking and savings accounts that millions of people keep on deposit in the nation's commercial banks. Over the years, bankers have learned that they have to keep in reserve for normal day-to-day customer demands only a fraction of the amount of money they have on deposit in checking and savings accounts, and the rest can be made available to qualified borrowers. The Federal Reserve System is the official agency that directly influences the volume of money and credit provided to our financial system. The country is divided into 12 Federal Reserve districts, each with its own Federal Reserve Bank. The Federal Reserve System is directly responsible to Congress. The activities and policies of the reserve banks and all subscribing member banks of the system are coordinated by a 7-man board of governors appointed by the President of the United States. This Federal Reserve Board of 7 governors, plus 5 representatives of the 12 reserve districts, make up the Federal Open Market Committee that formulates policies and actions. Today, some 5,000 nationally chartered banks are members of the Federal Reserve System, and most of the larger state-chartered banks are also members. Although member banks represent only 45% of the banks in the country, they hold more than 80% of all the nation's checking deposits. The Federal Reserve System requires that member banks hold reserves in the form of deposits at a Federal Reserve Bank, or as cash in vault, equal to a fraction of the bank's demand deposit liabilities to their depositors. At present, this required fractional reserve is about 1/7. For mathematical simplicity, let's say that these reserves are 20%, or 1/5 of the bank's assets, and the remaining all the bank's deposits support the bank's loans and investments. This fractional reserve policy enables commercial banks to expand the supply of credit available to borrowers. For example, let's suppose a depositor places $1,000 in his account. By regulation, the bank must put 20%, $200, in reserves at the regional Federal Reserve Bank, or keep it in ready till cash. Now the bank can loan the remaining $800 to a worthy company or individual. The bank thus creates an $800 deposit for a borrower, who will write checks against it for whatever purpose the loan was acquired. These checks will more often than not find their way into another bank, thus transferring $800 of money to a second bank. The first bank still shows $1,000 deposited on its books. Where there was $1,000 credited to one account, now there is $1,800 credited to 2 accounts. The second bank, by regulation, must place 20% of the $800 on deposit at the Federal Reserve Bank. Then it is free to put the remaining $640 out to work. Perhaps a loan to some enterprising woman to help her buy a business of her. A third bank, upon receipt of the $640 deposit, places $128, or 20%, with the Federal Reserve, and perhaps invests the remaining $512 in local, state, or federal securities to earn interest. Thus, in 3 steps, the original $1,000 has become $2,440. $1,000 at the first bank, plus $800 at the second bank, plus $640 at the third bank. And by the time this bank-to-bank creation of funds reaches the 25th generation bank, $5,000 has been created within the banking system, while $1,000, the equivalent of the original deposit, has remained on reserve at the Federal Reserve Bank, and $4,000 has been made available for loans and investments. Through research departments, Federal Reserve banks keep a watchful eye on the overall national economic outlook by constantly monitoring a wide range of indicators. If it appears that the economy is expanding too fast and inflation threatens, the Federal Reserve System can reduce the volume of money available for loans by changing the legal reserve requirements of member banks. To tighten credit rapidly, the Federal Reserve requirements for member banks could be raised from, say, 12.5%, or 1/8, to 20%, or 1/5. Thus, $10,000 in deposits would require $2,000 in reserve. The bank must sell some of its bonds or call in some of its loans to meet reserve requirements. Buyers of these bonds and borrowers repaying loans use their demand deposits to meet their obligations. This reduces the deposits to $6,250. In meeting the new reserve requirement of 20%, the supply of money available to borrowers has been reduced to $5,000, thus tightening credit. If indicators suggest a business session is in the wind, the Federal Reserve System can increase bank credit by reducing member bank reserve requirements. Suppose the Federal Reserve reduced reserve requirements from 20%, or 1/5, to 12.5%, or 1/8. All the member banks now would have excess reserves. For every $10,000 on deposit, the lowered reserve requirements would mean another $750 in loanable funds. These excess reserves would stimulate banks to expand their loans and create more deposit money, thus increasing the supply of money available to borrowers. The Federal Open Market Committee can also tighten or expand bank credit by selling or buying government securities. To tighten bank credit available to borrowers, the Reserve Bank sells government securities. The Federal Reserve Bank presents the check it receives from the buyer of government securities to a commercial bank for payment and deducts the amount of the check from the commercial bank's reserve account. This sale of government securities automatically reduces member banks' reserves and their ability to make loans and investments. To expand bank credit, the Federal Reserve buys government securities. The seller takes the check drawn on a reserve bank and deposits it in his commercial bank. The commercial bank presents the check to a Federal Reserve Bank that pays the check by crediting the reserve account of the commercial bank on the books of the reserve. In this way, the commercial bank gets more reserves and can make more loans and investments, which means more money available to the public. To tighten or expand credit, the Federal Reserve can also change its discount rate, that is, the rate of interest member banks pay when they borrow from the reserve banks. Subject to approval of the Federal Reserve Board, Each of the Federal Reserve district banks may raise or lower the discount rate for its district. Raising the discount rate makes it more expensive for banks to get reserves by borrowing from the Federal Reserve Bank. This discourages member banks from expanding their loans and deposits, thereby reducing the supply of money available to borrowers. Lowering the discount rate makes it cheaper for member banks to borrow reserves from the Federal Reserve Bank. This encourages member banks to make loans and create deposits, which increases the supply of money available for bank credit. All lending institutions study any change in Federal Reserve discount rates, which serve as a kind of pace setter for the interest rates that banks charge their borrowers. Thus, by changing legal reserve requirements of member banks, or by using the powers of the Federal Open Market Committee to buy or sell government securities, or by changing the discount rate, the Federal Reserve System can add money to the nation's banking system if a recession looms ahead, or withhold money if inflation threatens the stability of the economy. As for their part, the commercial banks provide the unique service of a means of payment by check. And they also use their ability under fractional reserve banking policies to make an adequate supply of credit available to qualified borrowers. To a man like Tom Wilson, the test of an adequate supply of credit is whether he can borrow enough money at a cost and on repayment terms that will permit him to buy what he wants or needs. To a businessman like the corporation president, the test of an adequate supply of credit is whether he can borrow enough dollars at an interest rate and on repayment terms he can afford to finance his expansion program to increase sales and profit. In a dynamic and growing economy such as ours, enough bank credit helps to maintain high and steadily rising levels of employment, production, and consumption. This raises some serious questions. How can government taxing, borrowing, and spending policies keep enough, but not too much credit available to borrowers? How can business and labor maintain wage and price levels that keep the value of the dollar stable? And perhaps most important of all, how can you learn enough about our complicated economy to support monetary and fiscal policies that will keep our dollar strong and our country prosperous?